You know, when you think about luxury in India, one name just pops into your head, right? Taj. For more than 100 years, it's been so much more than a hotel chain. It's practically woven into the fabric of the country. Today, we're going to dig into the story of its parent company, Indian Hotels, and its absolutely incredible transformation.
And that brings us to the big question we're tackling. How does a brand this old, this iconic, a real institution, manage to pivot, not just to survive, but to really thrive in a world that looks nothing like the one it was born into? Let's find out.
All right, so first things first, we have to understand what makes Indian Hotels, or IHCL as we'll call it, so special. This isn't just about plush carpets and fancy chandeliers. It's about a foundation that's incredibly deep and powerful, something that really sets it apart from everyone else.
And the source report we're looking at just hits the nail on the head. It's really a triple threat, isn't it? You've got this legendary brand, a massive network all across India, and this, sixth sense for what the Indian customer truly wants. That's a combo you just can't go out and build overnight.
So this is the crucial part, understanding the company's moats, the barriers that protect it from competitors. First, the brand itself, over a century old, creating a real emotional connection. Then the locations. Think about the Taj Mahal Palace in Mumbai. You can't just build another one of those. You add in their world-class service, a diverse portfolio that ranges from the super luxury Taj to the business-focused Ginger, and that deep, deep local knowledge. It's basically a fortress. But, even a fortress can face a massive storm. And the pandemic was exactly that for the entire hotel industry. So now we get to the really dramatic part of this story, how IHCL didn't just survive that storm, but actually used it to launch a huge strategic change.
And you can see that pivot right here. The old way was all about owning the properties. That's super expensive, it's slow, and it ties up a ton of cash. The new strategy? Go asset light. Basically, focus on managing hotels for other people, taking a fee for your brand and your expertise. It's way faster, it's more scalable, and frankly, it's a whole lot less risky.
So what do we actually mean by an asset-light model? Well, think of it like this. It's about making money from what you're best at. And for IHCL, that's their brand power and their operational genius, without having to spend billions on bricks and mortar. It's a really fundamental change in how they think about their business.
And a huge amount of credit for this successful turnaround has to go to the leadership. The analysis points directly to CEO Puneet Chatwal for steering the company through that crisis, for driving this new strategy, for cleaning up the finances, and, at the end of the day, delivering much, much stronger results.
Of course, a great strategy is one thing, but the results are what really count. So now, let's look at the what. The actual, hard data that proves this transformation isn't just a plan on a slide deck. It's real.
If we look at where the money is coming from, yeah, rooms are still the biggest slice of the pie, but look at that 12% from management fees. That right there is the asset-light model in action. And the report points out that this is a growing, very high-profit part of the business.
So, is the strategy working? The numbers tell a pretty clear story. First, just look at demand, a 71.5% occupancy rate. That means their rooms are full, and business is absolutely roaring back after the pandemic. And they're capturing more than their fair share. That's way above the industry average.
And all those full rooms, they translate directly into profit. At 12.8%, the company's return on equity is climbing. In simple terms, that just means they're getting way better at turning every dollar of investment into actual profit for their shareholders. That's exactly what you want to see.
This improved profitability has also let them seriously strengthen their finances. They've brought their debt-to-equity ratio all the way down to just 0.42. A lower number here is always a good thing. It shows they're being disciplined, they're less risky, and they've built a much stronger foundation to grow from.
And this slide just brilliantly shows their power in the market. These are two super important industry metrics. ARR is the average price for a room, and RevPAR combines that price with how full the hotel is. In both cases, the report's assessment is excellent and industry-leading. So they're not just filling rooms, they are filling them at top-dollar prices.
Okay. So the comeback is undeniable. But what about the future? That's the real question, right? Let's take a look at the road ahead and the strategy for what comes next. Their growth plan really sits on these 4 pillars. They're expanding beyond just the big cities, they're growing their more accessible brands, they are doubling down on that winning asset-light model, and they're making some smart moves internationally.
It's a really comprehensive and pretty aggressive plan for the future. And you know what's great for IHCL? The wind is totally at their back. These are what you call tailwinds, powerful industry trends that are just helping push them forward. You've got a boom in domestic travel, the massive Indian wedding market, better roads and airports, and business travel is coming back. It's a fantastic environment for them to grow in.
Okay, we've covered the history, the incredible transformation, and the future plans. Now it's time for the bottom line. What does all of this actually mean if you're an investor? This is the so what of the whole analysis.
So when you put IHCL side by side with its competitors, you see its PE ratio, which is just a common way to measure a stock's price, is around 28.5. That's a bit of a premium, but that premium is backed up by performance. IHCL has a higher return on equity and a better profit margin than its main competitor and the rest of the sector. So that sets up the key question.
And the answer is pretty straightforward. The report basically argues that investors are paying that premium price because they're paying for superior quality. The market sees the stronger brand, the better profits, and the healthier finances that we've been talking about this whole time.
The analysis then tries to project a range of what the stock could be worth in the future. You've got the bear case, which is if things go wrong, the bull case, if everything goes perfectly, and then there's the base case, at 650 rupees, which is what the analyst thinks is the most likely outcome based on where the company is headed.
And that leads to the final call from this particular analysis, a buy recommendation with a target price of 650.
So it really all comes down to this. We've seen the story of a legendary brand that has just masterfully reinvented itself. The company is, by all accounts, firing on all cylinders. But as the analysis shows, its stock isn't exactly cheap, and that leaves us with the ultimate investment question that the report poses. Are you willing to pay a premium for this kind of quality, or is the risk of a potential slowdown just too high? That's the crucial question to think about.